Hi, thank you for listening to Rivers Investment Channel. I'm Chi Yao. Last week, bond market tumbled on Trump win. As I mentioned in previous episodes, no market can be allowed to fall, and gold market will be downwardly manipulated. The huge reversal in gold and stock market had traders and mainstream media come up with an absurd conclusion to explain what was going on in the market. They just drew a story to fit in the direction of the market, regardless the logic. That only shows either how little they are aware of the situation or how much they want to fool the public. Let's draw a more probable outcome for bond market with Trump's fiscal policy. Without currency printings from the Fed, the spike in Treasury yields will deflate the bubble. The past week alone has wiped out $1 trillion worth of bond value. If the 10-year Treasury yield continues to rise and reaches above the real consumer price inflation, the cost of speculation will be so high that a collapse in various asset prices will succeed. The real problem is the government size is too big. Without cutting government spending and without the support from the Fed, the bond yield will have to skyrocket. Under Trump's plan, the increase in infrastructure and military spending with tax cut will put a significant pressure on the already over-leveraged government. With further QE program, Treasury yield, which is lower than consumer price inflation, aren't providing enough incentives for corporates to fund deficits with expatriated currency. Without further QE program, how are speculators able to afford the continuous price pressure from the new wave of real estate supply and increasing rates? Unlike speculators, who buy real estate just to flip it later for profits, manufacturers consider real estate as a cost of production. Today, a mid-sized factory will cost tens of millions, and that's just one section of a supply chain, and years to rebuild the entire supply chain. So, lowering tax and regulations for business still won't offer enough incentives for corporations to reinvest foreign profits back to the states. The return expatriate currency will be more likely to be used for asset price speculation, which will make the problem even bigger. The real solution is first to destroy the asset bubbles, including the currency bubble. And that is not the policy the Fed wants. So the Fed will come out and restart QE program to further suppress the bond yields until consumer price hyperinflation renders central bank economy out of control. Consumer price inflation will accelerate under Trump. However, the acceleration of consumer price inflation is the result of the economic plans before Trump turn. Trump wants to put currency in the hands of the people by lowering tax and increasing fiscal spending. The lowered tax may offset the tariff on imported products, but with the manufacturing basis long gone, the economy will still heavily rely on foreign imports. If the fiscal stimulus really go into the hands of the people without production facilities, the income increase for the middle class will turn into consumer price inflation. But unlike 1980s, where the US economy still had manufacturing bases to cope with high interest rate, the Fed now can't afford to front-run the consumer price inflation without popping the bubble. Companies will examine the feasibility on the new facilities. When the cost of production cannot be compensated by future profits, while cost of speculation is low, bringing foreign profits home will only help asset price inflation. For the foreign profits were to be used to rebuild factories, asset bubbles must be popped first, or rising asset prices will put more pressure on the cost to rebuild. But the current financial sector can't survive under the huge asset price deflation. To wrap it up, we are going to see the Fed trying to suppress the interest rate while the economic calamity is knocking on the door. Now, the economy faces a dilemma. Either we embrace the economic calamity now to rebuild later, or we continue the road to ruin and face the end of the empire later. Thank you for listening to Rivers Investment Channel. This is Chi Yao, signing out for now.